Good morning, good afternoon, or good evening, wherever you are tuning in from. It is Thursday, February 26th, 2026. The coffee is definitely hot today. The pre-market charts are just flashing green. And honestly, the vibes on Wall Street right now are, well, they're somewhere between euphoric and absolutely manic.
Yeah, manic is definitely the right word for it.
Right. And if you've been anywhere near a financial newsfeed in the last 12 hours, you know exactly why. Nvidia dropped its Q4 fiscal year 2026 earnings last night, and we really need to talk about it.
We definitely do. And look, usually earnings calls are, they're pretty dry affairs. You get some guidance, maybe a few percentage points of a beat or a miss, and everyone just kind of moves on.
Usually.
But this was different. I mean, this was the world's largest company sitting at a market cap of around $4.8 trillion, essentially telling the market that the normal laws of gravity just don't apply to them yet.
4.8 trillion. Just to contextualize that, for everyone listening, that is larger than the GDP of Germany. It is effectively the engine room of the modern global economy.
Yeah.
But today we aren't here to just read you the press release.
You're definitely not.
We've gone through the transcripts. We have looked at the analyst notes from the bulls and the bears and the technical roadmaps to really figure out the underlying story here. The mission for this deep dive is to answer one fundamental question. Is this the peak of the AI trade, or are we just seeing the opening of the second act?
And I think that is the exact right question to ask, because the narrative is shifting so rapidly. It's no longer just about buying chips. You're going to hear us talk a lot today about agentic AI, the Rubin platform, and really why nations, not just companies, are panic buying GPUs.
Right. So let's get right into it. The headline numbers were, frankly, absurd. But I want to push past that initial wow factor. What did these numbers actually tell us about the current state of the industry?
Well, let's start with the raw data. Revenue for the quarter hit a record $68.1 billion. Yeah, that is up 73% year over year. No, in a vacuum, 73% is great. But when you are already the size of Nvidia, 73% is mathematically supposed to be impossible. Usually, the law of large numbers kicks in and growth has to slow down. But here, it's actually accelerating.
And almost all of that is the data center segment. Like the gaming cards that Nvidia used to be so famous for, that's basically just a rounding error at this point.
It really is becoming that way. The data center segment alone brought in $62.3 billion. That's up 75% year over year. To put that in perspective, that single division made more revenue in 3 months than Intel used to make in an entire year during its peak dominance.
That is just staggering to think about.
And the profitability is just as stark. Net income soared 94% to nearly $43 billion.
Well, then let's pause on that for a second. $43 billion in net income. That implies profit margins that you typically only ever see in pure software companies.
Yeah.
But Nvidia is selling physical hardware. They have to manufacture things, they have to ship them, deal with supply chains. How are they maintaining software-like margins on physical products?
That is the magic of their moat. They aren't just selling a raw chip. They are selling an entire system. When you buy a Blackwell GPU, you are buying into the CEDA software ecosystem, the networking, the interconnects. You basically have no choice but to pay the premium because there is no viable alternative that runs the software stack as efficiently. It's effectively a monopoly premium.
Which perfectly explains the guidance. They are projecting $78 billion for Q1 fiscal 2027. They expect this train to just keep going. But here is where I have to play the skeptic for a minute. We have been talking about chatbots for 3 years now. ChatGPT, Claude, Gemini, we know them, we use them. But is the demand really exponential just for chatbots? Or is something else driving this massive consumption?
That is the ultimate pivot point in this earnings report. If this were just about chatbots, we might actually be seeing a plateau. But Jensen Huang, the CEO, spent a significant amount of time discussing the transition to agentic AI and physical AI.
Agentic AI. That was definitely the buzzword of the night. It sounds cool, but let's be real here. What does it actually mean?
Right.
Because to the average user, it still feels like we type a prompt and we get text back. How is this actually different?
Think of it this way. Generative AI, what we have now, is like an incredibly smart encyclopedia. You ask it a question and it gives you an answer. It produces content. Agentic AI is about execution.
Execution, okay.
Yeah, it's an AI that can reason, plan, and actually use tools to complete a multi-step workflow. It doesn't just write an email for you. It logs into your CRM, it researches the client, it drafts the contract, sends it out, and then actively follows up.
So it's the difference between having a tool and having a worker.
Exactly, and workers require a lot more thinking time, or what the industry calls inference compute. In the earnings call, they give a really specific example with Meta. Meta used this new Nvidia infrastructure not just to train a model, but to run these agents to dynamically optimize ads.
And what were the results of that?
The result was a 3.5 times increase in ad clicks on Facebook and a 1% gain in overall Instagram conversations.
Okay, well, that clicks for me right there. That is a direct line to revenue. If I am Mark Zuckerberg and I spend $1 billion on chips to get a 3.5x increase in ad performance, that hardware pays for itself immediately.
Precisely. And Jensen Huang actually had this exact quote. He said, computing demand is growing exponentially because compute is now revenue. Companies aren't buying these chips to run experiments in a lab anymore. They are buying them to generate profitable tokens.
Profitable tokens.
Yeah, it's a factory. You put electricity and chips in one end and you get revenue-generating actions out the other.
And this ties directly into that massive partnership with Anthropic, right? I saw that Nvidia poured $10 billion into them.
It does. They are building the Claude Cowork platform together. The underlying debt here is that every Fortune 500 company is going to want thousands of these digital employees running 24/7. And unlike a human employee who needs a desk and a salary, a digital employee needs a GPU. That creates a baseline floor for demand that is exponentially higher than just regular search queries.
So the software of these agents requires massive hardware. Let's talk about that hardware roadmap. We all know Blackwell. Demand is, as they said, off the charts, and cloud GPUs are completely sold out. But in the tech world, if you aren't aggressively killing your own product, someone else will. What is coming after Blackwell?
This is where Nvidia is just ruthless. They're moving to an annual release cycle, which is completely breaking the traditional speed of semiconductor development. The next big thing is the Rubin platform.
Rubin. We saw the initial teasers for that at CES. Is this just a slightly faster version of Blackwell?
It's much more than that. It is a fundamental architectural shift. Rubin is ramping up production in the second half of 2026, so later this year. It includes 6 new chips. But the most interesting detail to me by far was the Vera CPU.
A CPU? Wait, NVIDIA is a GPU company. Why are they bothering to make a central processing unit? Isn't that squarely Intel and AMD's turf?
It absolutely is. And that is exactly why it's a declaration of war. NVIDIA realized that in a data center, the bottleneck is very often the communication between the GPU, which acts as the brain, and the CPU, which acts as the traffic cop.
Oh, I see.
By building their own CPU Vera, they can tightly integrate the two. They claim the Rubin platform will offer 10 times lower inference costs compared to Blackwell.
10 times lower cost.
Yeah.
That is devastating for any competitors. I
Yep.
mean, if I'm a startup trying to compete with NVIDIA and they just drop the cost of running AI by 90% in a single generation,
Right.
how do I even catch up?
You basically can't. That is their entire strategy. They are accelerating the pace of innovation. They're breaking Moore's law effectively, so that by the time a competitor manages to copy Blackwell, NVIDIA is already selling Rubin. They are always staying one generation ahead.
But it isn't just the silicon either, right? I was looking at the segment breakdown, and the networking division is quietly becoming an absolute giant.
Quietly is the right word, but the numbers are incredibly loud.
Right.
Networking generated $11 billion this quarter. That is up 3.5 times year over year. This is driven by their Spectrum-X Ethernet and their NVLink technology.
Why does the networking matter so much, though? Why can't a data center just use standard high-speed cables?
Because when you are training these massive agentic models, you aren't just using one chip. You are using 20,000 chips that have to act as a single organism. If the connection between those individual chips is slow, the entire system just sits there and waits. NVIDIA realized that if they control the networking, they control the efficiency of the whole cluster. It is yet another massive lock-in mechanism.
There was one other category that really caught my eye in the report because it sounded more like geopolitical strategy rather than traditional business. Sovereign AI.
This is a fascinating subplot. Sovereign AI basically means nations, countries like Canada, France, Japan, Singapore, the UK, they are building their own AI supercomputers. They do not want to rely on Microsoft or Amazon for their national intelligence processing or their citizen data. They want their own physical infrastructure.
So is national security meeting big tech?
Exactly. And for NVIDIA, this specific segment tripled to over $30 billion. It is so crucial because it heavily diversifies their customer base. Everyone always worries, well, what if Amazon stops spending? What if Google cuts back?
Right, the hyperscaler risk.
Yeah, but, well, now you have the nation of Japan as a customer. Countries do not turn off their national infrastructure infrastructure as easily as corporations cut their capex.
That acts as a massive stabilizer for their revenue. It effectively turns AI compute into a public utility, just like electricity or water.
Which brings us to the broader market perfectly, because if Nvidia is the power plant, who are the ones building the transmission lines? Who else gets rich in this ecosystem?
We're going to break down the sympathy plays, the stocks that are riding NVIDIA's coattails, and we'll also talk about the one analyst who thinks this is all a massive bubble right after this quick break.
Stay tuned.
If you like what you are hearing today, we invite you to subscribe to the channel. Leave a like and comment on what topics you would like us to cover in future deep dives. In the description of this video, you will find a PayPal link if you want to support this project. Your contribution helps us a lot to keep creating content like this. We don't ask for more than the price of a coffee. Thanks for your support.
All right, let's get back into it.
Okay, we are back. So the sympathy plays. If Nvidia is the proverbial gold rush who is selling the shovels, or maybe more accurately, who is supplying the metal for those shovels.
The sources highlighted 3 specific companies that are absolutely critical to this entire ecosystem: TSMC Micron and Supermicro. Let's start with TSMC.
Taiwan Semiconductor, they are the foundry. They physically manufacture the chips that Nvidia designs.
Oh, right, but it goes much deeper than that. It isn't just about the manufacturing, it is about the packaging. There is a very specific technology called CoWoS, which stands for chip-on-wafer-on-substrate. It is incredibly hard to do, and TSMC is the only company on Earth who can do it at the scale required for Blackwell.
So they are a literal bottleneck.
Exactly. If TSMC cannot package it, Nvidia cannot sell it. Because of this leverage, TSMC is projecting gross margins of 63 to 65% next quarter in 2026. They are effectively operating as a toll booth on the entire AI economy.
Okay, so TSMC is the bottleneck for manufacturing and packaging. What about Micron? They make memory.
Micron is the bottleneck for bandwidth. These incredibly fast AI chips require high bandwidth memory, or HBM. You can have the fastest processor in the world, but if it cannot access data fast enough, it just sits idle. And right now, there is a critical global shortage of HBM chips.
In economics, one tells us when demand is vastly higher than supply.
Prices go straight up. Micron has massive pricing power right now. They can basically dictate terms because Nvidia, AMD, and everyone else are desperately fighting for their HBM allocation.
And the third one on the list, Supermicro, SMCI. They have had a pretty volatile history in the markets, but they are heavily in the mix right now.
They are the rack builders. They take the Nvidia chips, the Micron memory, and they put them all into a massive server chassis with custom liquid cooling, and then they sell that finished unit to the data center. Their CEO, Charles Liang, expects revenues to hit $12.3 billion next quarter. They are the ultimate speed-to-market play. If you are a company and you want a data center up and running, now you call Supermicro.
So that is the incredibly bullish trio.
Yeah.
But I did promise our listeners we will play devil's advocate. When everyone is this universally excited, when the numbers look this perfect, that is usually the exact moment you need to check your blind spot.
Yeah.
What is the bear case here? Is there a legitimate one?
There is, and it is very important to listen to it. We looked closely at a note from Jay Goldberg at Seaport Research. He is currently the only major analyst with a sell rating on Nvidia.
The lone wolf. That takes some serious courage in this market. What is his core argument?
It's partly about those physical constraints we just mentioned. He argues that even if demand is truly infinite, supply simply is not. TSMC can only build so many factories so fast. If Nvidia cannot physically ship more chips because the laws of physics and supply chains get in the way, the stock price might be running way ahead of reality.
It is a very solid supply side argument. But what about the demand side? I keep hearing whispers on Wall Street about the CapEx wall.
This is the $700 billion question. The hyperscalers, Amazon, Google, Meta, Microsoft, they are collectively spending nearly $700 billion on capital expenditures. That is an astronomical amount of money to lay out. The primary worry on Wall Street right now is ROI, return on investment.
Right, because if I am a Microsoft shareholder, eventually I want to see that $100 billion infrastructure investment turn into $200 billion in actual profit.
Exactly. And if agentic AI doesn't take off quite as fast as predicted, if companies don't streamline their workflows and replace human tasks with digital agents fast enough, then the actual software revenue won't materialize. If that happens, Google and Microsoft might panic and just cut their spending.
And if they cut spending,
Nvidia's order book evaporates overnight. We call it air pocket risk. You are flying high, everything feels smooth, and suddenly the air underneath you, the core demand, just disappears.
That is a genuinely terrifying thought for anyone heavily leveraged in tech right now. And we really cannot ignore the geopolitical element either. China is still a huge question mark in all of this.
It is a massive one. Remember, Nvidia's current guidance assumes absolutely zero revenue from China data centers due to U.S. export regulations. They are completely locked out of one of the biggest markets on Earth. If Chinese companies like Huawei successfully build their own highly efficient AI chips simply because they are forced to be, Nvidia loses that market forever. That is a long-term strategic risk that isn't going away.
And one final small detail I noticed in the report, gaming. I know we said earlier it is a rounding error, but gaming revenue actually dropped sequentially by 13%.
It did, and that confirms where their priorities are. Nvidia is aggressively diverting silicon away from gamers to feed the insatiable demand of the data centers. It is a very smart business since margins are significantly higher in AI, but it does mean their foundational consumer business is basically on life support right now.
So bring this all back home. We have a company growing at 73% at a $4.8 trillion scale. We have a completely new technology paradigm in agentic AI that promises to automate actual complex work. We have a hardware roadmap with Rubin that is breaking Moore's law. But we also have a massive dependency on 4 or 5 huge customers who absolutely need to prove their ROI soon. What is the final verdict here? What is the overarching vibe?
The vibe is that this is a fundamental structural shift. The broad consensus from Goldman Sachs, who, by the way, just kept their $250 price target to the ground-level tech enthusiasts, is that data centers are becoming the new power plants. They are the fundamental foundational utility of the next decade.
It really feels like we are watching the Industrial Revolution, but it's being compressed into a 3-year window.
That is a fantastic way to put it. And the real question for the listener isn't just should I buy Nvidia stock? It is much broader than that. If compute equals revenue, as Jensen says, then every single company across every sector needs to figure out how to turn chips into money to survive.
And that is the exact provocative thought I want to leave everyone with today. If compute equals revenue, then what happens to the companies that simply stop spending? Are they being financially prudent and saving money? Or are they just actively deciding to become obsolete? The cost of not participating in this AI build-out might actually be vastly higher than the cost of the chips themselves.
It is a high-stakes poker game for sure, and right now it looks like everyone is pushing all their chips into the center of the table.
And with that, we reach the end of today's deep dive. We hope you liked it, that you learned something new, and that you will join us for the next one. Thank you very much, and we will meet again very soon. Remember that in the description of this video, you can find the PayPal link if you want to help us out. Thanks once again. Greetings.
Thanks for listening, everyone.
Hola, muy buenos jueves.